One. Rising coaches, welcome back. We've got the second installment of 5 questions on finance with Corey Callahan, financial advisor for Wells Fargo. Hopefully you guys tuned in and saw the first 5 questions. We had a lot of really good Q&A, and hopefully some of the coaches out there were able to gain a little bit of knowledge on finances. And we've got 5 more, Corey. So appreciate you being with us here again today. And we ready to dive into this?
Of course. Thanks for having me again. Appreciate it.
No problem. All right. Question number 1. What are some ways a coach can save for their children's future and education?
So it really depends on what your goals are in helping your children with education expenses. But one of the best options, hands down, is what's called a 529 college savings plan. Depending on the state that you live in, there can be some tax advantages to the parent or the custodian of the account, along with those who contribute to the account. So not just the account owner. This is a helpful incentive in having relatives, grandparents, et cetera, help contribute to your child's account. Just keep in mind, you'll have to have the intention of spending this money on a qualified school expense or expenses. Otherwise, you'll lose that full tax benefit that the 529 provides. And that can be a big deal, obviously. But if used correctly, though, you will have a tax-free growth vehicle on the earnings, which is obviously a huge tax benefit when looking at the long-term growth opportunity. No other investment in vehicle is really going to give you that type of benefit. So keep that in mind. And each state offers a sponsored plan. And I would recommend doing research online or speaking with an advisor or an accountant to find out what 529 options are best for you depending on the state you live in.
Yeah, like personally, we, for our daughter and then our child that's going to be born here soon, we have a 529 set up for our daughter, and we'll have one set up for, any children that we have. So that's something that we are taking advantage of, currently as we speak right now in preparing to save for their future and their education. So no, that's a great point. Let's talk a little bit about debt. As I know it's something we talked a little bit about and we touched on during the first episode, but what's the best way to essentially pay off debt in your opinion?
Well, the best way to pay off debt is to have a plan. That's my personal opinion. So know the interest that you're paying for the debt that you hold, and then look to pay off the higher cost loans first. Very important. So this will save you money in interest paid. Also, make sure you don't take out any unnecessary credit card debt. Credit cards are notorious for charging ridiculous amounts of interest. Therefore, the less credit card debt you have, the better, right? Also, know your budget. If you know your budget, it's easy to create a system to pay off the debt you have while having an idea of how long it actually will take to pay off that debt. Having a plan and knowing the timeline can really help relieve some of the stress that debt puts on us. That's really important.
Does the current interest rate environment kind of play a role in your advice when it comes to debt and paying off debt?
Yeah, good question, especially given the interest rate environment we're in. So, of course, we have had a low interest rate environment for quite some time now. Therefore, some forms of debt could be considered healthy. For example, buying a home and having a mortgage. There may be no better time in history for our generation to either buy a home or refinance your mortgage, again, because rates are so low. So not all debt is good debt, and too much debt can really hinder financial plan success. But given the interest rate environment we're in, something like buying a home, you really could benefit from that in the long run.
Go along those same lines, Corey. You're talking about, buying a home and some things like that, goals that are 5, 10, 15, 20 years down the road. What would you advise people to look for when they're looking at their future and their finances? Again, 5, 10, 20, 25 years down the road.
Planning, obviously is really important. So having clear goals can always help you achieve success when it comes to financial planning. And segmenting these goals can really help put things into perspective so that you don't become too overwhelmed with focusing on, let's say, a 20 to 30 year time horizon, right? Which is quite difficult. So I like the idea of knowing what you want to accomplish financially every 5 years or so. So goals and objectives will also, without a doubt, change as life goes on. Therefore, make sure your goals are realistic, but also make sure you're giving yourself an appropriate timeline. As you get into the later stages of life, you'll have a much clearer picture of what retirement lifestyle you might want to live. Therefore, it'll be a little bit easier to hone in on your retirement financial goals, at that point in time. As for the younger years, again, going back, as I mentioned previously, just make sure you're saving and investing and keeping your debts down. If you do these three things, you're really staying ahead of the game.
Retirement lifestyle. I'm just thinking of what mine's gonna ideally look like, and it's
you might never get there.
You know me too well. That's what happened. Knowing me for 20 years or so. Where should you put money that you'll need in 2 to 5 years, 5 to 10 years, 10 plus years, like things like that? Where should you put money that you'll need in those time frames?
Good question. So looking at actual investing for those timelines, that's a little bit different than what we just talked about. So let's start with the long term. Any money that you're confident you won't need for 10 plus years can be focused on retirement type accounts or investment accounts with more of a long-term objective, right? So it gets a little trickier as your time horizon shortens simply because of the market risk that you might be taking on in that window of time. So a 5 to 10 year window is still a decent length of time, but you might want to scale back the risk a little bit. The worst thing that you can do is invest money into a security or an investment with the intent of it growing, but then having less than you started with, at which point in time you need the money, right? So you'll want to be somewhat cautious if you're needing the money, somewhere around 5 years or less down the road. If you need the money in a year or two, so really short term, you really want to be careful. In most cases, again, because interest rates are low, I would recommend simply keeping this money in cash or just a safe cash alternative. This way, there's absolutely no market or investment risk, very important. And again, because of interest rates, you won't be getting much interest or yield, but you also won't be putting the principal at risk, which I think is probably more important given the time horizon we're looking at.
No, I think that makes a lot of sense. That really does. All right, last question that I have for you, although I may have a follow-up after that. Although some coaches aren't really thinking about retirement just yet, how can one kind of make sure, a sharp downturn in the stock market doesn't affect a planned retirement date?
Okay, so you have to look at long-term when investing and planning for the later years in life. There will always be volatility in the stock market. That's never going to change. And there will also be periods where the market is moving in the opposite direction of what we want it to, right? So if you have a long-term time horizon, you can financially handle these type of swings in the market. Let's use the Great Recession of 2008, for example. So it was a tough time for investors, without a doubt. But as time went by, the investors that stayed disciplined, they ended up recovering. It took time, but they did recover. The investors that pulled out of the market near the bottom or at the bottom, they missed the beginning of a recovery or the recovery. And that's a critical time to be invested from a return standpoint. So it really changes the total return from, person A who stayed invested compared to person B who got out and then later on got reinvested. It's hard at times, but it's so important to try and ignore the emotional side of investing.
So in theory, and I know it's a follow-up question to that question I just had, like in theory, is it a good time to be adding money, like when times are difficult?
Yeah, in theory, yes, it is. And history tells us that. And this is simply called dollar cost averaging. It can really play a significant role in helping with returns over time. So as volatility and or a market pullback occurs, it can work to an investor's advantage to use this as an investing opportunity. As you buy on the way down and buy on the way back up, your returns will reflect this. You'll be much better off than trying to time the market while making emotional decisions, right? So keeping your risk tolerance in mind, but staying disciplined, that's probably the most important thing for long-term success. But if you're able to, adding money at intervals during those volatile times will also help on the recovery side on the way back up.
Dollar cost averaging. I remember that from one of my finance classes that I took. So hopefully this is ringing some bells. So throughout the course of these 2 segments that we've done, 5 questions on finance, I may have squeezed you for a couple more answers, but I think some of these keywords that have been standing out is all stuff that I think we've heard before. So Corey, I appreciate you joining us again. Corey Callahan, financial advisor for Wells Fargo. Corey, we thank you for your time. We thank you for your wisdom and your insights and for your support of Rising Coaches.
Thanks, Andy. Anytime. I appreciate what you guys do. And obviously I'm here for you if you ever need anything else.
I appreciate you. Thanks, Corey.
Thanks, brother.